Very good evening to everyone and welcome to Kings of Capital webinar. We have been seeing rapid growth of unsecured credit and NBFC credit in the recent past. And with increase in risk in this segment, recently RBI raised risk weights on both of these lending products. Basically, asking lenders to keep aside more equity capital for the same risk. We will discuss the various implications of this change that it has on lending industry in general and KCP companies in specific. And today we will also touch upon Q2 results for our portfolio companies. To take us through all of it, we have Tej with us. Tej is the fund manager for our Kings of Capital fund. Tej, over to you if you can take us through both the topics, and then we will open for Q&A.
Thank you, Nitesh. So like Nitesh said, we'll first discuss the implications of what will happen with RBI's move to increase risk weights for unsecured lending and lending to NBFCs. What are the implications for the industry? We'll discuss both short-term and long-term implications. And then followed by that, we'll also give you a specific update on the fundamentals of our portfolio companies and what's the outlook for them in specific. So starting with the backdrop, we'll discuss why the RBI has done what it's done. If you were to take a relatively long time period, FY 2016 to FY 2023, or say 6 months, ended even October 23, we've seen that credit cards outstanding have grown at about 26% CAGR. These are credit card loans, and other personal loans. This is all RBI disclosed data have grown at about 21% CAGR. This is in the context of the lending industry as a whole growing at about barely low double digits, which is 11% to 12% CAGR. This is why we read all about unsecured loans. This is why we read that for the first time, consumer loans or personal loans or non-corporate loans have become a larger proportion of overall credit for the lending industry. That's because if a couple of segments grow at 2x, or in the case of credit cards, 3x the pace of the overall lending industry, that is what is a bit concerning for the RBI from a risk perspective, also from a concentration perspective. So that's the backdrop. Certain segments growing at 2 to 3x of the overall credit growth, which also amounts to 2 to 3x of overall nominal GDP growth. That is what the RBI was concerned about. Second aspect, this was the more macro picture. The second aspect was, if you were to take the very recent history, loans overdue for more than 1 day were up to almost about 10.5% versus anywhere between 8.5% to 9% before COVID. So a slight uptick on an extremely large base because, as we saw, unsecured loans, credit card loans had grown at 20 to 30%. On that 10.5% 1 day past due, that was one data point that the RBI had. Second data point, which is something which is more relevant to us as investors, is that if we were to segment this stress, or if we were to segment the exposure of personal loans and unsecured loans into various categories of lenders, and the broad categories be PSU banks, NBFCs, private banks, and even within private banks, we can categorize them into large private banks and the rest of the banking system, the rest of the private banking system. If we were to broadly categorize the type of borrowers into those with a credit score which is below 650, because a credit score of below 650 would imply that these are high-risk borrowers. And the way to read this is, on a 5-mark rating, the lowest possible credit score is 300, the highest possible is 900. Anyone who has a credit score of above 650, or you could say 700, is a low-risk borrower. As a lender, lenders are generally comfortable lending to people who have a credit score of above 700 on this rating. So therefore, if you were to look at the chart of the bottom left in this context, we can see that state-owned enterprises or PSU banks have about 52% exposure as in June 2023 to people who are high-risk borrowers or borrowers who have a credit score of less than 50. On the other hand, private banks have an exposure of only about 30% to these high-risk borrowers. We can further delve into out of these high-risk borrowers, who are the highest risk borrowers, which is credit score of between 300 to 400, who are a bit less risky, which is a credit score of 580 to 650, and there is a category somewhere in the middle. So on this basis, the chart on the bottom left of the screen tells us that one, personal loans, credit cards outstanding have grown at an extremely high rate, anywhere between 20 to 30%. Of that, in a high growth segment, who are the ones who are lending to the high risk borrowers? We can see that state-owned banks, which is PSU banks and NBFCs, have the highest exposures. PSU banks at about 52%, NBFCs at about 50% of their overall lending done to these high risk borrowers. On the other hand, large private banks, the type of banks that we have in the portfolio, have only about 30% lent to high risk borrowers. One more thing to keep in mind, which has a credit score of 650 and more. And therefore, you've seen across the board, apart from NBFCs, we have seen that versus March 20, proportion of high risk lending is lower. However, on a relative basis, as investors, we need to look at who has got the most exposure to high risk lending. We believe that this is with the PSUs, as the data suggests. Now, the chart on the left shows us what it looks like on an AUM basis. The chart on the left is the balance sheet number, is the stock figure. The chart on the bottom right is telling us what are the disbursements looking like. This is for the last about 18 months time period, where if you were to look at the overall industry, 22% of lending is done to people who are in the high risk category. Of that, again, it's the the PSU banks and it's the NBFCs who've got the highest exposure to high risk borrowers. Again, what this suggests is that even on an incremental basis, it's not that the stock numbers and flow numbers are significantly different. Even on an incremental basis, PSU banks and NBFCs continue to do more riskier lending in the unsecured and the personal loan segments than the private banks. So that's a takeaway for us from a investor perspective. While the RBI will do what it does for the system as a whole, for investors, the learning for us is that if there is some large credit event on the unsecured side, on the personal loan side, the large private banks are more insulated. The NBFCs and the PSU banks are largely more exposed to credit risk events on this side. Moving on, so in this context, what are the actions that RBI took? So RBI could see the high growth in some of the segments. The action that RBI took, these are largely, as the RBI says, preventive measures. It's not that there is some for the same these banks and NBFCs are doing, and the RBI is more concerned with the lending which is happening on the unsecured side. So the increase in risk weights have no implications on secured products, whether it's vehicle loans, whether it's gold loans, whether it's mortgages, whether it's housing loans. There is absolutely no implication on these products. As a result of this, we believe that the short-term implications are pretty obvious, and these implications the market also appreciates. As soon as the RBI's action and circulars came in, across the board, we saw a stock price correction because the market appreciates that this will lead to slowdown in secured growth. It will also lead to slowdown in industry credit growth because the largest contributor to incremental growth has been unsecured and personal loans over the past, especially 18 to 24 months. So what we saw was an across the board correction in stock prices. However, we believe that the long-term implications of this are still not adequately captured by stock prices. So long-term implication number one is reduced competitive intensity from both type of players, which were shown on the earlier slide. which is fintechs. These are NBFCs who are unlisted. These are NBFCs who recently raised capital. They've raised, in some cases, a lot of capital, and reduce competition from PSU banks. The reason that this will happen is because fintechs have a large proportion of their balance sheet exposed to unsecured credit. They will now see a higher increase in cost of funds than the type of banks and NBFCs that we own. PSU banks, because they are capital starved, and they'll be left with two options. One is they either go and raise equity capital, which will be dilutive, massively dilutive for their shareholders, or they slow down on growth for unsecured credit. So reduced competitive intensity is one implication which we'll see in times to come. We've already started seeing early signs of that with what's happened to Paytm. The second implication, apart from reduced competitive intensity, is that you will see, because for the sector you will see loan growth coming down, you'll also see that the fight for deposits will reduce. So if loan growth for the sector is going to come down, and that reduction in loan growth is largely going to happen for players who are capital starved, which is PSU banks, then the private banks will be, especially the large private banks, they'll be in a much better position to raise deposits at much more competitive rates. If they want to grow their balance sheets at 18 to 20%, which they've been doing over the past few years, then they'll also be able to raise deposits and grow deposits at 18 to 20% with much less competitive intensity than what we've seen over the past 12 to 15 months. And then finally, incremental capital coming into the sector. And by that, I mean not only private equity and venture capital funds investing on an incremental basis, lower amounts of capital, because threshold to get to above cost of equity, return on equity has just gone up. So you now need to leverage, say earlier you needed to leverage 6 to 8 times to get to above cost of equity, return on equity. Now you'll need to leverage much more than that, which might not be possible. So that's one part of lower incremental capital coming into the sector. The other part is even incumbents, even the large banks or even existing NBFCs would want to get into unsecured lending. They'll think twice about it, because now they'll need to set aside 25% more capital to get into unsecured lending, and therefore the ROE math changes for them as well. As a result of these 3 or 4 changes, we believe that pricing on unsecured credit will go up. And for incumbents who have well-established business models, who are well capitalized, and are long-term sustainable players in the unsecured market, they'll be able to make better NIMs. As a result of that, better return on assets and return on equity on the same unsecured book versus what they were making 12 to 18 months ago. So getting into the math of what's happening, and this is going to be a bit technical, and therefore I would request the audience to stay with me on this. Starting from the bottom of the table, if we are assuming 2.5% return on assets for a lender, this is before the risk weight increase. What that means is that for every 100 rupees lent by the lender on every 100 rupees of assets lent, you're assuming that the lender will make about 2.5 rupees. This is post expenses, post interest expenses, post operational expenses, post providing for NPS. After all of that, after providing for tax, we're assuming that on every 100 rupees lent by a lender, the lender will make 2.5 rupees. On that 2.5 rupees, we assume that the lender is leveraging about 10 to 11 times. That's how, hypothetically, the lender is making 27-28% return on equity. Now, in the new world, what will happen is, after the risk weights have increased, the best that a lender can do is, instead of leveraging 11 times, the lender will be able to leverage only 9 times. Because the lender will be able to leverage only 9 times, the peak return on equity for a 2.5% ROA lender is now 22%. It's no longer 28%. Because this is extremely harmful for lenders who are at peak leverage, that is, lenders who are already leveraged 11 times, this will be life-changing for them. On the other hand, Lenders who are not leveraged 11 times, they're already at say 6 times, 7 times, 8 times, which is most of the lenders or almost all of the lenders that we own in KCP. The increase in risk weights don't change anything for them at all because they're already below the 9 times number. Secondly, the lenders in the KCP portfolio, especially on their unsecured book, they make much more than 2.5% ROAs. So a typical lender in the KCP portfolio would be making anywhere between 3 to 5% ROAs on the higher risk segments that they operate in. That is leveraged anywhere between 6 to 8 times. That's how they make the 18 to 20% return on equity that they make. On the other hand, we've seen a lot of PSU banks being leveraged 12 to 18 times. They're making 1% ROAs, they're leveraged 12 to 18 times, and that's how they're making the 15 to 18% return on equity. It's for those type of lenders that the change in risk weight is going to be a material dampener on returns on equity. Because if you are leveraged 15 to 18 times, you're quite close already to the tier 1 limits that the RBI has prescribed. And then those sort of lenders will have to make one of two choices. Now, one of two choices being they need to either slow down growth so that capital consumption reduces, or they need to go and raise more equity so that their tier 1 is far above the regulatory threshold. And if they choose this option of raising more equity, because these lenders trade at one-time book or around or less than one-time book, it will be dilutive for shareholders. So that's the broader math of why KCP lenders are already on this table, less than the right side of this table, or less than the 8.5 times or 9 times leverage. They're making more than 2.5% ROAs, and therefore are the least or they have no impact, or they have no impact on the business models. While most of the rest of the ecosystem, which is 60% of the Indian lending industry, which is PSU banks today, are on the left side of this table. Now, coming to the specific large banks that we own in the portfolio, let's take HDFC Bank as a case study. HDFC Bank has about 11.5% of its loan book exposed to unsecured loans, which is personal loans, credit cards. We're taking both of them. Let's say it's 11.5% fully exposed to unsecured loans. On this, plus on the NBFCs, which are borrowers from HDFC Bank, which is an additional, say about 2% of the portfolio. So 11.5 plus 2%, 13.5% of the HDFC Bank overall portfolio will see an increase in risk weights. As a result of this increase in risk weights, HDFC Bank's impact on its tier 1 is about 0.5%. So HDFC Bank is already at about 17.5% capital adequacy or tier 1. That 17.5% goes down to about 16.8%. Similarly, ICICI Bank, post the increase in risk weight, goes to 16%, Axis Bank goes to 14%, Kotak Bank, which is the least impact, goes to 20%. So across the board, we see whether it's Axis Bank, which is at 14% post the increase in risk weights, or Kotak Bank, which is at 20% on the other extreme post the increase in risk weights, they're far above the regulatory threshold on tier 1 capital. As a result of this, there is no change in business model, nor do the big banks, big private banks need to raise equity capital, nor do they need to slow down lending. So we believe that this has no fundamental change in the capital structure, business model, sustainable returns on equity, or sustainable returns on assets for any of these big four banks. On the other hand, they will see, we believe, a better NIM because pricing on unsecured loans will go up. We believe unsecured loan pricing, as lenders start pricing in the increase in risk weights, and as the lenders start pricing in the fact that they need to set aside more equity capital for the same amount of unsecured loans they give out, they'll be able to charge better. Secondly, it's also a function of market forces. If today there are, say, 100 lenders in the market lending into the unsecured lending market, maybe that number goes down to 70 lenders doing unsecured loans. And therefore, all of these big four banks will be able to also, from a market perspective, from a demand and supply perspective, charge higher on unsecured loans. Now, moving on to the NBFCs, Bajaj Finance, which has, you could argue, the highest amount of exposure to unsecured loans in the portfolio, because about 50% of the loan book is exposed to unsecured loans and to what the RBI has done in terms of increase in risk weights. Again, it has got no change in business model. It has, despite 50 to 55% of loan book exposure to unsecured loans, you will see absolutely no impact on return on assets or sustainable returns on equity. The reason for this is Bajaj Finance has always maintained that you will stay between the 5 to 7x band on leverage. It's always raised equity capital when it's reached between 16 to 18% tier 1. And from that perspective, it was far above the regulatory threshold. Even before RBI prescribed the new risk weights, it's never ventured near the 10 or 12% tier 1 mark, which is the regulatory threshold. As a matter of fact, Bajaj Finance raised capital just about a month before RBI's new risk weight norms came in. So what's happened is its tier 1 capital, whatever it was, went up because before RBI's risk weight norms came in, because it raised equity capital, and suddenly RBI increased risk weight norms, and again Bajaj Finance tier 1 went back to what it was before the fundraise. So absolutely no change in outlook for Bajaj Finance. It actually benefits the most. If you were to look at the long-term implications, Bajaj Finance benefits the most from what RBI has done as the largest player doing unsecured lending in the most sustainable, most profitable way. And it will, we believe, see an improvement in net interest margins on a like-to-like basis if you were to exclude the impact of whatever the interest rate cycle they're going through. On a like-to-like basis, it will see an improvement in spreads. Chola again, exposure is not obviously as high as Bajaj Finance, but Chola again raised capital just before the risk weights increase in risk weights was announced. It has a tier 1 capital, we believe, which is significantly lower than Bajaj Finance, but it has a tier 1 capital to support growth for the next at least 18 to 24 months. But given the growth trajectory that Chola is on, it might have to raise capital if it wants to sustain the high growth rates that it is currently on. It might again have to raise capital, say maybe 24 months out, despite the fact that they've recently raised capital. Because only about 10% of the loan book is exposed to the increase in risk weights, we don't believe there is any material change in their business model, sustainable returns on equity or tier 1. Finally, coming to Home First and Awas. First of all, RBI has specifically excluded housing finance companies when it comes to the liability side increase in risk weights. So what I mean by that is RBI has done two things. One is it has said you need to set aside for both banks and NBFCs. RBI has said you need to set aside more capital when you do unsecured lending. Secondly, what the RBI has also said is, this is specifically to banks, that if you are lending to NBFCs, then you need to set aside more capital. But this is only for NBFCs which are not housing finance companies. In that context, Home First and Awas get completely excluded and have absolutely no impact on the liability side. So we believe that from a portfolio perspective, whether it be the large banks, whether it be the NBFCs, whether it be obviously the insurance companies or Prudent or Info Edge, who have absolutely no impact or nothing to do with the lending sector, we believe that this circular from the RBI on increase in risk weights was like a gift for our portfolio, because there's significant positive long-term implications on the portfolio, absolutely no short-term dampeners or short-term negative implications, which might be the case for rest of the lending industry. If we were to think of this as investors from a competitive advantage perspective, this plays superbly well for the type of companies which we own, which have low leverage, a great business model which delivers consistently high returns on asset. These companies do not rely on excessively high leverage to boost returns on equity. They do not do unsustainable short-term lending or unsustainable unsecured lending. They've been through, in the case of Bajaj Finance, 15 years of solid unsecured lending cycles where they've shown that they've done exceedingly well they have done significantly better than the rest of the industry. In the case of Aavas Home First, they do only secured lending. So we believe this plays beautifully to our portfolio, and they will gain massively in the long term over the next 18 months as we see numbers on net interest margins, which has been a large focus area for a lot of investors. As we see those numbers come through, we believe that this will be a massive positive for our portfolio. So if we were to look at the timeline of what's happened in the recent past, November 23, 16th November is the precise date on which RBI increased risk weights. Within a week of that, Berkshire Hathaway completely exited its Paytm stake. Obviously, smart investor, no one to comment on them. But within a week, they realized that this is something which will massively impact players like Paytm, because those lenders who use Paytm as a sourcing engine, say like Aditya Birla Capital, were capital starved, are capital starved, have a massive exposure to unsecured lending, and they were the first ones to pull back. So Zest Money, again, fintech player, shut down within about 20 days of the RBI circular. And if we were to move ahead, this is what happened to Paytm over the past few days. So what happened to Paytm, we believe, is a precursor, hopefully, to what will happen to the rest of the ecosystem, which is the partners that Paytm sources loans for. They did the right thing for their balance sheet, and we believe even for their stakeholders, which is they saw that on an incremental basis, from a signaling perspective, RBI is saying slow down. In case you want to have a relook at the type of unsecured lending that you are doing, you should have a relook at that, given that you're seeing high growth in this pocket. Secondly, at for say the largest partners of Paytm, Aditya Birla Capital or a Fullerton, they would have relooked at their leverage, the tier 1 ratios, and would have seen that from an incremental basis, if we start or continue to grow at 20, 25, 30% on the unsecured loans bit, it will consume a lot of capital, and therefore this is the right call for them as an organization. And as a result of that, we saw that Paytm, for the specific less than 50,000 rupee unsecured loan bucket, pulled back on those sorts of loans. Now, versus that, it's quite interesting to know what Bajaj Finance did. Bajaj Finance, about 6 months ago, going back to this timeline, November 23 is when RBI increased risk weights. The timeline, on the other hand, what Bajaj Finance followed is a super proactive lender, what a classic lender, great lender does, which is between March 23 to November 23, in those 6 months before RBI increased risk weights, Bajaj Finance, first of all, raised incremental capital. They raised 10,000 crores of equity in those 6 to 9 months. Part one. This is despite the fact that they were leveraged anyways only about 6 times or 5.5 times. On top of that, they raised 10,000 crores of equity capital. Part two, they reduced lending to the 15% of the most imprudent customers, which they thought were the most imprudent, proactively. Not because they saw an increase in the 1+ DPD number on their books, not because they saw gross NPAs go up. They thought that these bottom 15% customers are the customers who've taken more than one loan, which is a BNPL loan or maybe even a secured loan, in the less than 50,000 rupee category. And because they believed that these are a class of customers who are not even over leveraged, these are a class of customers who their data identified is imprudent, they cut down 15% of exposure to them. If Bajaj Finance would have continued lending to them, instead of the 30% loan growth that Bajaj Finance has reported, Bajaj Finance could have reported 33%, 35% loan growth. But despite not seeing an increase in NPAs, despite not seeing an increase in 1+ DPD, they chose to go for prudence. They chose to go for 30% loan growth instead of an easy 35% loan growth. As shareholders, we would have been happy. We would have been typing out notes and numbers saying, see, great, 35% loan growth is back for Bajaj Finance. But they chose to grow at 30%, which is a more sustainable long-term strategy. They chose to raise equity capital, 10,000 crores of capital, and bring down the leverage back to 5 times. And that's what prudent lenders do. So that's the timeline for a classic lender versus what's happening for the rest of the industry, which is fintech lenders shutting down, ATM also pulling back on 50,000 rupees and below ticket size loans after the increase in risk weights have been announced. And that is why we believe that investing in quality lenders, investing in lenders which consistently generate high returns on assets, is a strategy which works well for long-term investors. For investors as us, who are invested for not the next quarter or this financial year, but who want to be invested for the next 3 years, 5 years, 7 years, this is a strategy. The strategy on the left-hand side of the slide, which is low leverage, high returns on asset, which delivers high returns on equity, healthy returns on equity, is a much more sustainable strategy than going for lenders who deliver 19-20% return on equity on the back of 20 times leverage in 1 year and then 12% ROE the next year, just because the leverage profitability ROA keeps on fluctuating. So the message of this slide is that a high ROA tells us that the business is quite good, it's quite sustainable. And we'll cover this in the next 2 to 3 slides, which is that for all our lenders, HDFC Bank, even for the type of lending it does 2% ROA, which is 2x the average of the PSU banking system. Home First and Awas do 3.5% ROAs. Bajaj Finance does 5% ROA. All of them do this on a leverage which is significantly lower than the rest of their peers. So the Home First and Awas do this at a leverage which is significantly lower than LIC Housing. HDFC Bank does it at a leverage which is half that of their PSU lenders. Kotak Bank does it at a leverage which is about a third of its PSU lenders. Similarly, Bajaj Finance does unsecured lending at a leverage which is about a third or about, say, maybe half of some of its peers. What this helps them do is they always have the option to improve leverage or increase leverage if they feel comfortable with the environment. If they don't feel comfortable with the environment, they can always go and raise more capital, which is what exactly that Bajaj Finance and Chola have done. They have additional optionality to deal with instances like increase in risk weights, instances like COVID, instances like ILFS. But if you are at a 1% ROA as a PSU lender and you see an increase in risk weights, or if you see a 0.5% increase in NPAs, then there is no optionality left. You go back from 1% ROAs to 0.5% ROA, and 0.5% ROA into even 20 times leverage will give you only 10% return on equity. So we want lenders who operate on this virtuous cycle of deploying equity capital in great sustainable business models which deliver high returns on asset, gear that up not by 15 times, but anywhere between 6 times to 10 times, generate profits, generate healthy return on equity, again, deploy that capital back into the business. If they feel comfortable with the leverage and if they want to increase leverage, then great, they keep on doing this. If not, then they always have the option to raise equity capital. So here is where we stand. These are the banks in our portfolio. The NBFCs, just to give even more comfort to KCB investors, are leveraged even lower than these banks. So on one extreme, on the left side of the screen, we have Canara Bank, we have PNB, we have SBI, leveraged 15 to 18 times. On the other extreme, we have Kotak Bank. The companies that we are invested in, they are the ones in this chart in green. We have Kotak Bank to Axis Bank 6 to 10 times. So half the leverage of all of these companies and still deliver similar returns on equity. And therefore, it's the companies in red which will have the most impact of increase in risk weight assets, increase in RWA by RBI on unsecured loans. The companies on the right obviously have their life doesn't change. They continue to do business as they did even before the increase in risk weights in November 23 by RBI. Now, moving to our portfolio, this was the overall context of what happens if increase in risk weights actually is implemented with full vigor. We believe an further increase in risk weights of 25% by the RBI will be even more positive for our lenders because it will really suck out capital from the system. If we were to talk about the recent history, FY19 to 22 and FY23 for our portfolio. These are the numbers. These are numbers that a lot of you might be familiar with, which is FY23 as a year as a whole was quite healthy for the portfolio. Healthy in two ways. One is, as a portfolio, the company has generated about 20% return on equity, about 25% operating profit growth, so about 25% loan book and therefore revenue growth. This is better than own history of these companies. Secondly, this is even also better than the rest of the industry and therefore their competitors. So on operational fundamental basis, these businesses are doing extremely well. However, as you can see in the last two columns, there is still quite a bit of catching up to do on share prices, because the share prices have not gone up by 25%, which is the operational profit growth. If we were to move on to the recent most quarter, we can see that the strength of fundamentals is continuing. There is no loss of business momentum. These companies continue to grow market share. These companies continue to grow at very healthy rates. And it's not that the loan growth or the balance sheet growth is coming at the cost of profitability. So net NPA number is 0.4%. YOY PAT growth is about 30%. Even if we were to exclude HDFC Bank, the 50% number is because of the merger. Even then, the number is upwards of 20% and is quite healthy. The same holds true for the non-lenders. Across the board, we are quite happy with the performance. The minus 2% for ICICI Lombard on PAT growth is because of a YOY tax adjustment, which is not reflected in the PAT growth number. But if you were to look at profit before tax growth, again, it's around the 18 to 20% mark, quite healthy. So we are quite happy with the fundamental performance. The only place where we've seen some slowdown is Awas, where the disbursement growth is not as healthy as we expected it to be at the start of the year. We expect Awas to grow even disbursements at 20 to 25%. Because if they don't do that, this loan growth number of 22%, as there is some possibility that instead of 22%, they report 15 to 18 to 19% if they don't catch up on disbursement growth. That's the only sort of stock that we are keeping, or business that we are keeping an eye on, where we are doing some more work, speaking to management, doing our own channel checks. But otherwise, nothing to complain about on the portfolio as a whole in terms of fundamentals. Again, this is a comparative slide versus the Bank Nifty. So if we were to do an apples to apples comparison only on fundamentals, we can see that from FY17 to FY23, every year, our companies have delivered better returns on assets. So ROAs for Bank Nifties, for the KCP portfolio versus the Bank Nifty, has been usually about 100% better, which is this portfolio delivers twice the returns on asset versus the Bank Nifty. Like I've said now multiple times, the leverage is lower, which is how we prefer it to be. And therefore, even on a lower leverage, the portfolio delivers healthy return on equity. Now, the difference versus the Bank Nifty is our portfolio is much more expensive optically. Our portfolio is at a 4.5 times price to book versus the Bank Nifty is at about 2.5 times price to book. Now, the premium multiple which you're paying for the KCB portfolio is obviously for quality of management teams that run these companies. You got Bajaj Finance, Kotak Bank. These are the relatively more expensive companies on a price to book basis. Secondly, you also get better growth and better returns on asset, which are extremely useful in times like these when, say, RBI increases risk weights. If we were to then talk about valuations in this context, right? Yes, it is expensive than the Bank Nifty. But if we were to talk about valuations in the context of their own history, HDFC Bank is now trading at a 20-year low on price to book. It's trading at a significantly lower number on price to book than before pre-COVID levels. but also significantly lower than what it has ever traded at if you were to exclude the global financial crisis. Same case with Kotak. Kotak's at a 10-year low on price to book. HDFC Life is also at a 20 to 30% discount on valuations versus pre-COVID levels. Same is the case with ICICI Lombard and Aavas. Now, one reason that this has happened is because we've seen a lot of turnaround stories. We've also seen PSU banks do better than what they used to do before COVID. But if we were to look at financial history, if you were to look at the last 10 years, this has always been the case. There are years when some of these lenders suddenly do extremely well, but it's only till the next credit event happens that these sort of lenders, which go through their own ups and downs, which are extremely volatile, extremely leveraged, they do well. They usually do well for 2-3 years, and it's again back to the likes of HDFC and Kotak, which again start doing better. And not to mistake the derating with fundamental performance, because the fundamental performance, like I showed on the even previous slides, has been impeccable. We could have not asked for better fundamentals. Even versus the expectations of the general market, this is on the slide what the market expected these companies to deliver in terms of EPS. This is EPS expected for financial year ending 2023 as on 1st April 22. Even versus that, even versus market's expectations, say for example, Kotak beat those expectations by about 50%. So the stock price derating is not because they've disappointed the markets on earnings. It's only because on a relative basis, the market is finding significantly more value in some of the PSU banks or turnaround stories. So across the board, even on 1st April 2022, whatever was the earning estimates across the board, KCB companies have beaten those estimates. If we were to take earnings estimates, and these are from Bloomberg, so these are consensus estimates from a large number of analysts, even if we were to take those estimates as on 1st April 21, 1st April 2020, the beat or the proportion by which those estimates have been beaten, they would have been even higher. Because remember, on 1st April 21, we were sitting in the middle of the second COVID wave. On 1st April 2020, we were sitting in the middle of COVID. So across the board, KCB lenders have continued to beat expectations. Their performance on fundamentals has been better than their own history. And on top of that, they're gaining market share. What all of this has resulted in is you're today getting a portfolio which is seeing quarter after quarter 25% earnings growth, quarter after quarter improving returns on equity, and a 25% earnings growth portfolio with about 19-20% return on equity is available at about 24-25 times P multiple. And the quality of names, like I've shown on the screen, you already know. It's in such a market, we believe that a 24-25% earnings growth at 25 times earnings is a great portfolio from both a valuation perspective and even from a quality perspective. Because unlike the small and mid caps, this is not extremely now expensive, nor will a HDFC and Kotak Bank see a sharp or steep correction when there is a correction which is eventually bound to happen in the small and mid cap space. If we were to even take into account this, what this chart shows is if we were to take into account the 21-22% rally that we have seen in the KCB portfolio in this financial year, even after factoring in that rally, we are still to see catch up to earnings and catch up to fundamentals. Because what we have seen is this chart shows from Q2FY24, this is September 2020, when we launched the portfolio till now, over this 3-year period, the stock prices are still trailing earnings. Because we've shown this from September 2020, you can be rest assured September 2020 was first wave of COVID. So we did not buy any of these stocks, or we're not at a starting point where these stocks were expensive, because we bought financial companies in the middle of COVID. From then on to now, if we were to see the earnings growth has been 20% plus, but stock price performance has not still caught up to that, even after factoring in the 21-22% rally that we have seen in the past 9 months in this financial year. So just to catch up to current earnings, the stocks have to go up a further about 20% just to catch up to the current earnings, and then they can compound at the 20% mark, which is in line with earnings. So that's why we believe that this portfolio is a great buy even at today's valuations, even after the 21-22% run up that we have seen over the past 9 months. Now, coming to stock price performance again, this is how we've seen KCP since inception. The initial year or so, the post-COVID recovery was solid. Then, for a period of about 18 months, when we saw FIIs pull out money, we saw the Ukraine-Russia war, the Fed hike rates by about 5%, we saw a correction, and that is what we've been able to recoup in the past 9 months. This has again been accompanied by solid FII inflow. So again, over this time period, our performance since inception, if you were to look at it, has been about 10%. This number is maybe a couple of percentage points higher given the performance that we've seen in this month, but is about that number. And to break down this 10-11%, this is how we look at it. But versus that 10-11% number, there is still massive catch up to do because the portfolio has not caught up to earnings fully. And we believe that this catch up will happen because the portfolio is available at 24-25 times earnings, continuously grows at 25%, which is quite powerful because even if the portfolio, let's say, does not re-rate, 25% earnings growth itself will let the portfolio compound at a healthy rate. So I'll stop over here. Back to you, Nitesh.
Thank you, Tej. That was really useful. I will request all the participants, if you can please type in your questions on Q&A box that is at bottom of the your slide, or if you can please type, I can pick it up and we will try to address as many questions as possible. So Tej, there are a couple of questions on what is the reason for slowdown witnessed in disbursement for Awas, if you can share your views. And Kotak, any take that Mr. Kotak has now retired and new CEO being appointed who is not within the system. So how do you look at it?
So first, I'll answer the Awas question. I think, like I said, that is something that we are well aware of. That is a stock or that is a business that is the only one which is lagging on growth and the metrics that we track. This is a phenomenon of the last 2 quarters. So till FY23, Awas was very fine on disbursement growth. Asset quality forever has been impeccable over the last 10 years. That's not an issue. Now, there are 2 issues, and the reason that Awas is lacked on growth, they're twofold. Reason number 1 is they're going through a tech transformation. So when we visit Awas branches, we can corroborate whatever the management is telling us on the tech transformation. When we visit Awas branches, whether it be in Jaipur, whether it be in Rajkot, whether it be in Indore, we can see that the branch level staff is being trained on how to use Salesforce. They're being trained on the new loan management system. And because of that, because these changes are being implemented across the 300 branches and the thousands of employees, there are some teething issues. That's part number 1. Part number 2 is we've seen a change in the CEO. Along with that, we've also seen some ground level attrition, which is in one way an industry challenge. On top of that, Awas is seeing a more deeper version of that attrition because they've also seen a management change at the top. What that has led to is in some of these locations, the branch level team has completely changed. They've either been poached by competition, they've either left to some other place. As a result of these 2 factors, we've seen disbursement growth slow down to about 10%. If disbursement growth does not pick up, Awas will end the year with, even if disbursement growth does not pick up, Awas will end the year with anywhere between 15 to 20% loan. But we believe that with every passing quarter, disbursement growth is picking up. So quarter ended September was better than quarter ended June. Quarter ended December will be better than quarter ended September. If that is the case and this trajectory continues, they will end the year with about 20-21% loan growth, which is not great, but which is not bad either. FY25, we believe on the back of an average sort of a year of rebuilding, we'll see about 25% growth in profits, or maybe even better, because there will be productivity benefits which would start coming in. That's our take on Aavas. At these valuations, we believe that Aavas can do significantly better on stock price performance. And we believe there is significant upside on Aavas at these valuations if they deliver on two things. One is they get disbursement growth back on track and productivity starts improving. Sorry, the second question on Kotak.
Yeah.
Kotak Bank, yes, there has been an external CEO in place. Our default assumption, on which, to be honest, we've been proven wrong, was there will be an internal candidate. The RBI maybe has pushed Kotak, maybe not, we don't know, but the RBI maybe is more comfortable with an external candidate at Kotak Bank, given that the promoter, Mr. Uday Kotak, has been running the bank for more than 30 years. The RBI would have preferred that someone who is already at the bank, an internal candidate, maybe would be subject to influence of Mr. Uday Kotak. And if there is an external candidate, there will be maybe no backseat driving, and the external candidate would run the bank on his own terms. So that's what the RBI perspective is. We believe that Kotak Bank is an institution which is, even on a steady state basis, even with an average, tenure of leadership of 20 years, without even Uday Kotak in the picture, has run all of these businesses for a long period of time at 15 to 20% growth and has consistently gained market share. As an institution, Kotak Bank is extremely conservative. So whether we look at any of the credit events which have happened over the past 10 to 12 years, two names stand out: HDFC Bank and Kotak Bank. HDFC Bank stands out because the systems processes 4% cost of funds. Kotak Bank stands out because even at 6% cost of funds, even at 2% higher cost of funds than HDFC Bank over the past decade, it has entered and exited segments at the right time. It has done lending. It has not grown at 20% every year like HDFC Bank. It has done lending only when it has felt comfortable. For Kotak Bank, balance sheet and survival have been of paramount importance, rather than what the next quarter's P&L number looks like. I've never cared about next quarter's P&L. I've neither cared about what balance sheet growth, what loan growth for the next year looks like. Because the promoter has owned 25%, he's had a high skin in the game. He's always known that a DCF's real value is not over the next 3 years or 5 years. In a lending business, what matters is this: with a 6x leverage, stay on the extreme right when it comes to balance sheet protection of this cohort, leverage the least, always focus on survival. If you survive in India, where nominal GDP growth is 11%, lending industry growth is 13-14%, all you need is a bit of more market share. You can easily grow at 18-20%. All you need in a business which is leveraged to the hilt, all you need is survival. Because Kotak is leveraged 6 times, does 2.5% ROAs. Hopefully they can do maybe better if they get activity right. It can, even without Uday Kotak in the picture in the management seat, we believe, do best ROAs in the industry, be on the highest quartile on even returns on equity on a sustainable basis. And we believe Kotak has everything that we look out for in a long-term investment, which is great governance, a long-term track record of solid underwriting and prioritizing the long-term over the next quarter, consistent growth of 18 to 20% over long periods of time, and even without Uday Kotak, a management team which is even one layer below him, for been there for about 20 years. So yes, it's been not something which we expected when it comes to the external CEO, but I don't think it raises questions on growth, raises questions on long-term stability.
Okay. There are few queries on underperformance in terms of the benchmark. Obviously, you have shown in your charts the fundamentals has been very, very strong. Do you think ultimately stocks prices will catch up with fundamentals and by when, do you think it will happen?
Sure. So I think one is that these valuations have come to an all-time low, and that's the reason that in the past 6 months we've seen fundamentals and stock price both moving in the same line, which is a 20% growth being reflected in the stock prices. Because the valuation that come to a point where these were looking like value buys even to investors who would stay away from some of these names just on the basis of valuation. So for Kotak Bank, for example, a lot of investors have known that Kotak Bank is a great company, but they stayed away from a Kotak Bank or a HDFC Bank because at 4 times price to book, some of these investors were unwilling to buy these names. But even value investors who want to buy these names at 2 times price to book started buying HDFC or a Kotak Bank because these valuations for them were at a 20-year low. So that's point one. Point two is when the real fun will begin is when some of these names on the screen go through a credit event. So some of these companies, for example, if there is a credit scare or if unsecured loans actually go through an event where they see say 5% gross NPAs, then say SBI is trading at 1 time book and at 11% tier one, then SBI might have to raise capital because they're just at the margin of raising capital. If they go through a 5% gross NPA event on their unsecured book, then they will either have to slow down that lending or they will have to raise capital. And a lot of money will then move to some of the names that we own, which is the HDFCs and Kotaks of the world, because there will be a scare in that market. So for a long period of time, we have seen, say, for example, between 2010 and 2015, Yes Bank used to trade at the same multiple as HDFC Bank. Then suddenly a lot of money moved to HDFC Bank, and it did not happen overnight. Yes Bank traded at the same valuation for a period of 5 years. But then suddenly a lot of money moved to HDFC Bank as soon as the India Bull's DHFL crisis happened. Similarly, a lot of money will move. We saw that for a very brief period in January this year. As soon as the Adani news, Hindenburg news came out, not only did all the Adani stocks crash, a lot of PSU banks also crashed for that 1 or 2 months period. And all of that money moved to HDFC and Kotak. But again, now there is normalcy in the market. Money is again moving to some of these names on the screen. Now, our responsibility and our job is to not get satisfied or not get lulled into buying some of these names just because they are trading at 1 time price to book. Because we've seen these cycles over the last 10 years multiple times, where it's the most consistent players, where it's players who have a long-term track record, who have a long-term history, which survive through multiple cycles. Why is there no housing finance player apart from HDFC Limited, which has done extremely well? Why is there no great bank over the last 20 years which has done well apart from HDFC and Kotak? Why do some of these names just do well for 2 or 3 years in a great cycle and then again go through their own events, through their own issues? There are real answers to that. The real answer is because these banks prioritize the next quarter, prioritize loan growth over asset quality. They do well in a good macro, and their fortunes are really dependent on a great macro, on great credit cycles, staying there for a long period of time and not really on their own underwriting. As soon as industry NPAs go through the roof, the men will be separated from the boys. And that's when we'll be able to see much better performance from our stocks. There's nothing to complain from fundamental perspective, but stocks will do significantly better when there is much more differentiation on asset quality.
Got it. So basically, given that lenders are a leverage play, during upcycle, all the lenders look same.
Yeah.
It's only in down cycle, we can figure out difference between high quality lender and an average lender.
Yeah.
And given as days follows night and night follows day, there will be cycles. During difficult times, we can clearly see why it's so important, especially in lenders, to stick around with quality names. Fair enough. One of the queries on Paytm, I think you had mentioned, but again, if you can just quickly elaborate that Paytm does not use its balance sheet, but still, the price got impacted because of change in the rules.
So just to be clear, we don't own Paytm, not a stock under coverage also, but what happened was Paytm is, you could say, a sourcing engine for some of the large lenders, not for any of the lenders that we own, but say for Aditya Birla Capital, it's a sourcing engine where Paytm sources the loan and the loan resides on the balance sheet of Aditya Birla Capital or a Fullerton. So when these lenders lend their balance sheet to Paytm for the sourcing, they pay Paytm a fee for the sourcing. Paytm only earns a fee income. There is no balance sheet risk or any risk which resides on the balance sheet of Paytm. But because that fee income overnight evaporated into thin air, Paytm stock corrected. That fee income no longer exists because all the loans which are below the 50,000 rupee ticket size will no longer be there from maybe next quarter onwards. And that's why the steep stock price correction. Now, from our perspective, right, why is this helpful? This is helpful because a lot of space just going back to implications, long-term implications of this. The long-term implications, like I said, we are starting to see, which is fintechs most exposed, they'll withdraw. A lot of existing players who are starved of capital, they'll withdraw. So any fintech who has been a sourcing engine will also withdraw. Any player who has less tier one will also withdraw. Any fintech who is taking unsecured balance sheet risk will also withdraw. When they withdraw, Bajaj Finance, which cut down the bottom 15% of its exposure, most risky exposure, like I said, on its balance sheet, they'll be the ones who will be able to gain market share because they'll be able to see that there is incremental room available to lend to the same customer because there is no longer Paytm lending to them. So that's where market share gains will happen. Secondly, Bajaj Finance will be able to lend to them at maybe 15% instead of 14% because there is room to price higher for the same loans.
Got it. If you can also give your views on general insurance side, competitive intensity, how it has been, and ICICI Lombard, what is the competitive landscape, given the new age players are coming in, and recent changes in the management of ICICI Lombard.
Sure. So yes, Bhargav Das Gupta, who is the CEO, recently moved on, and this was something which is well known. By March of 2024 is when, as per regulations, he had to retire because he had been as a CEO of a general insurance company for a period of 15 years. So 15 years ended in March 24. So this was well known. Succession plan for him was in place. The person who replaces him as the CEO has been with the ICICI group for a very long period of time and with ICICI Lombard also for the past 6 to 7 years. He was the head of retail lines, and retail lines are a large part of ICICI Lombard's business, which is motor insurance, health insurance, say about. All of that put together is about 60-65% of ICICI Lombard's business. So he already used to head the 60% or 65% business of ICICI Lombard, which is a large contributor to returns on equity and profitability of ICICI Lombard. So the transition, we believe, has been extremely smooth. Secondly, the CFO plus most of the people who are one layer below the CEO have been with ICICI Lombard, again, very similar to Kotak for a period of 20 years. ICICI Lombard is known to be a CEO factory for the rest of the industry. So despite a lot of people going on to become CEOs of all their competitors, most of the people in the leadership team of ICICI Lombard have been there for a period of 20 years. So we believe this has been quite a smooth transition and no issues with the way the transition has happened. Secondly, on the competitive landscape, before that, one more point. Bhargav has already disclosed that he has bought, actually, even after him moving on and retiring, he has bought about 2 lakh more shares of ICICI Lombard. So he's gone on to the market, exercised his ESOPs. He's already disclosed this to the market, and now we can also see in the publicly disclosed data on the exchanges that he has gone on to buy more shares by exercising his ESOPs of ICICI Lombard, even after his retirement. Further gives us more confidence. On the competitive landscape, ICICI Lombard continues to accrete market share on corporate lines of business. Anywhere between 13 to 17% is their market share. over the past, I would say 4 to 5 years, the market share on corporate lines has doubled. So that is an area where competition for ICICI Lombard is just fine. They've been easily able to gain market share. On health lines, health is a business which retail health is a business, especially which they have recently launched. There, they only have a 3% market share versus about a 10% market share on an overall basis in the industry. So they are quite early in the game. They obviously have a lot of room to catch up. Their market share can go from 3% to 10%, and they are working hard on that. It's not a matter of competitive intensity on health insurance. It's a matter of what ICICI Lombard has as a capability and whether they can execute on the retail health insurance market, because it's a new area for them. Coming to motor, where competition is actually an issue, on motor insurance, ICICI Lombard's market share is now about 9.5%. And over the past 18 months, they've continuously ceded market share. They've consciously given up market share because they believe that the pricing at which motor business is being written, they can't make sustainably high ROEs. And they waited and waited for either competition to abate, demand to improve, TP prices, which is third-party motor insurance pricing, from the regulator to increase. And finally, in the last 2 to 6 months, they've seen some uptick. They stopped at least ceding market share at the pace at which they were ceding market share. So market share losses, the rate of market share losses has slowed down. So that's the picture on motor insurance. So we believe that ICICI Lombard should continuously grow at 15 to 20%. If they start gaining market share on motor, it will have a kicker on returns on equity and growth both. And we believe that is what even the stock market is waiting for. Their stock will do even better. To be clear, stock is up 40% this financial year, but their stock will do even better if they can improve market share on motor insurance.
Okay. There's one query on Bajaj Finance. Their 2 products were banned by SEBI or RBI. So any update on that? What's your view or take on it?
Yes, 2 products of Bajaj Finance banned. This is separate from whatever has happened on the risk weights. This is action specifically taken by RBI on Bajaj Finance. Now, these 2 products do not constitute any significant part of AUM. We believe that if, say, Bajaj Finance was expected to grow at 31-32% this financial year, now they will grow at 29-30%. Do not expect any material change in profit growth or return on equity or AUM growth.
Got it. Again, you have answered multiple times, but still, if there's a query on Info Edge, why do we have it in KCP portfolio, and what's your view over there?
Yeah, so Info Edge also, I'll cover the fundamentals, continues to do well, especially profit growth is 30% plus in a market where actually IT recruitments have slowed down. Despite that, they've been able to report robust profit growth because they've cut down on advertising spend. And despite cutting down on advertising spend, given that they are a monopoly, they've been able to get incremental volumes and they have not lost market share. So quite happy with that bit. Info Edge is a part of KCP because we see them as a venture capital business, which is a type of an asset manager. So more than 50% of Info Edge value can be attributed to their venture capital business. This is the business from which the likes of Zomato and Policybazaar were seeded. This is how today Zomato and Policybazaar are listed entities. 10 years ago, 12 years ago, Info Edge invested in these companies just as a financial investor. Over time, they've delivered outstanding results for Info Edge as a shareholder. And today they have a large book. They've got Temasek as a co-investor, and they've got a large book of such unlisted venture investments, which over a time, hopefully, some of them will become the next Zomatos and Policybazaars of the world. That's how, as an asset manager, Info Edge is a part of KCP.
Got it. One interesting question, one of our attendees are saying, given that you are bullish, or in a sense, given HDFC Bank and Kotak Bank has done so well in terms of fundamentals, and stock has not moved. Why don't you increase, or will you plan to increase the weight in your model in a portfolio?
Yes, we've already done that. I think that's the right observation. HDFC and Kotak, not only in Kings of Capital, but also in our other portfolios where we hold HDFC and Kotak, including consistent compounders portfolio. We've gone on and increased our weight in both of these companies, given that business momentum, fundamentals have continued to compound, but stock prices have not moved. And this is a feature of the market. This is not a bug, but this is a feature of the market. I remember a lot of questions on Axis Bank, for example, till about 12 months ago. Axis Bank is now up 50-60% from where it was. Axis did not do anything for a period of 3 years, and now it's up 50-60%. 6 months ago, HDFC Life was written off. Life insurance as an industry was written off because of the changes which were there in the budget. In the past 6-9 months, HDFC Life is about 45%. Similar is the case with ICICI Lombard, and today we get no questions on HDFC Life. Fully that will be the case with HDFC Bank and Kotak Bank from here.
Okay, and I think on Bajaj Finance, do you think it's still attractive given the valuation where it is, and what's your growth prospects over there?
Bajaj Finance growth prospects or business momentum does not change. But on a relative basis, out of say a Bajaj versus a HDFC Bank, from a valuation perspective, HDFC Bank, given where it is trading at, is more attractive. So to be clear, Bajaj Finance will give better ROEs and better growth, but HDFC Bank is available at a better valuation. So our top 3 holdings in KCP, therefore, are HDFC Bank, Bajaj Finance, Kotak Bank, in that order.
Got it. I think that's all for today. There are few queries left. We will reach out to you separately and try to address that. But thank you so much, Tej, for the call, and thank you everyone for joining the call. I look forward, to see you again in our next edition of Kings of Capital webinar. Thank you so much, and have a great evening.
Thank you, everyone.